Let me be real with you right now. The stock market is hurting. Popular names are getting absolutely wrecked. Growth stocks, down hard. Software, even harder. And here's the wild part. We haven't even entered an official correction yet. That means the S&P 500 is still less than 10% off its highs, and yet some of the stocks sitting in your portfolio are already in a full-blown bear market, down 20%, 25%, even 30% from their peaks. So here's the question everybody is asking right now. Is this the beginning of something much worse? Or is this the buying opportunity we've been waiting for? In today's video, I'm breaking down exactly what's going on in the market, why it's happening, and most importantly, whether I'm buying the dip or parking my cash on the sidelines. We're also going to talk about specific stocks and ETFs worth watching, so stay locked in. This one matters. The volatility spike. Let's start with what triggered all of this, volatility. When markets get volatile, two things happen. Number one, fear starts spreading fast. And number two, if you know what you're doing, opportunities start showing up. But here's where most investors go wrong. They react emotionally. They either panic sell at the bottom or blindly buy every dip without a plan. Neither one is a strategy. Because buying the dip only works when you're buying quality businesses at reasonable valuations. And that's the exact problem we walked into heading into 2026. The market got way ahead of itself. The AI hype train ran hot, valuations stretched well beyond reasonable, and a pullback was almost inevitable. Think about this. Microsoft was trading at over 35 times forward earnings. Apple, a company growing at a fraction of Microsoft's pace, was priced right in line with it. And the S&P 500 as a whole was sitting in the mid-20s on a forward PE, when its long-term historical average is around 18 times. That's not sustainable, and the market is now correcting for it.
Where the S&P 500 stands right now. The S&P 500 peaked in late January of this year. Since then, we're down roughly 8% from those highs. It feels worse than it is, but it is what it is. Now, we're 5 straight days closing below the 200-day moving average. That's a key line of defense for individual stocks, ETFs, and major indices alike. Once you're trading below it consistently, it's a warning sign. The next major support level I'm watching is 6,360, and we're sitting about 1% away from that right now. Here's some context that might calm your nerves, though. On average, the S&P 500 sees at least a 5% pullback every single year. A 10% correction? That's nearly an annual occurrence. Our last official correction was March 2025. That's almost exactly a year ago. So in that sense, we're right on schedule. And here's some good news on valuation. The S&P 500's forward PE has finally dropped below 20, sitting at 19.9 right now. That hasn't happened since the tariff scare in spring of 2025. We're starting to look more reasonable.
Why this is happening now? So what's actually driving the fear right now? It comes down to two words. Uncertainty. First, the U.S.-Iran conflict. That's pushing oil prices higher, which is feeding into the price of goods that need to move internationally. That creates inflationary pressure the market wasn't expecting. And when inflation runs hotter than expected, it directly impacts the Federal Reserve's playbook. Just a few weeks ago, markets were pricing in 2 rate cuts in 2026. Here's where we stand today. The April Fed meeting? No cuts expected. And there's now a small but real probability of a rate hike being priced in. Look further out, through all meetings into July of 2027, and the market is now pricing in more hike probability than cut probability. That's a dramatic shift in a very short window of time. Why does this matter? Because a lot of investors were loading up on growth stocks specifically in anticipation of rate cuts. Cheaper debt means more growth capital. That thesis just got flipped on its head. And on the economic side, the Atlanta Fed is still projecting 2% GDP growth, which is nowhere near recession territory. But that number was at 2.7% just a few weeks ago. It's moving in the wrong direction, and fast. What should you actually do? All right, enough doom and gloom. Let's talk about what to actually do with all of this. Step 1. Look at your portfolio honestly. Is it properly allocated for your goals and your risk tolerance? If not, right now is the time to fix that, not after things get worse. Step 2. Identify where you're overextended. The portfolios getting absolutely crushed in this environment are the ones with no foundation, no balance, and too much speculation. Quality is your armor right now. Let me give you an example. Nvidia. This company is sitting on over $62 billion in cash, with only $11 billion in debt. Its free cash flow is approaching $100 billion. That's what a fortress balance sheet looks like. When the economy slows down, companies like this don't just survive, they compound. Now look at valuations. Some of the names that were untouchable a year ago because of the price, they're suddenly starting to look interesting again. Meta is now trading below a 20x forward earnings multiple. Microsoft is also crossed below that threshold. These are premium businesses at prices we haven't seen in a while. How about Netflix? Down 30% from its summer highs. The Warner Bros. Deal is done, yet it's still trading below where it was when that deal was announced, by nearly 10%. And think about this from a macro perspective. When the economy slows down, people don't cancel Netflix. They stay home and watch movies. It might be one of the last subscriptions families cut. Or look at a name like AVGY, one of my favorite dividend plays, down 10% since the start of March alone. Healthcare exposure at a discount. I'm not telling you to go all in. Nibble here, nibble there. Be deliberate. But if you come across high-quality companies at genuinely great valuations, you don't want to be sitting on your hands. ETFs to consider. Now, if individual stock picking feels overwhelming right now, ETFs are a great way to put money to work while managing your risk. Here are 3 worth considering. SCHD, broad exposure to dividend-paying companies with a solid yield and a strong track record of dividend growth. Great for building a stable foundation. XLG, this one tracks the top 50 stocks in the S&P 500. If you want exposure to the Mag 7 and other mega-cap growth names on the dip, but don't want to pick just one, this gives you the whole basket. SPMO, a momentum ETF tracking roughly 100 names within the S&P 500. Broad exposure, rules-based, and built around names showing relative strength. These aren't speculation plays. They're ways to put money to work systematically, with diversification built in.
I'll be straight with you. Things probably get worse before they get better. Until there's some resolution in the Middle East, uncertainty isn't going anywhere. But markets have always rewarded those who stayed disciplined, stayed focused on quality, and didn't let emotion drive their decisions. That's the game plan right now. If you found value in this breakdown, tap that like button. It helps the algorithm push this to more investors who need to hear it. And if you want more market updates like this, drop a comment below and let me know. Join the Discord using the link in the description below. I posted the valuation breakdown we talked about in today's video inside the community, and I'd love to see you in there. And hey, every Thursday at 4 p.m. Eastern, right at market close, I go live for a full market recap. Come join us. It's free, it's live, and it's worth your time. Thanks for watching. Stay patient, stay smart, and I'll see you in the next one. Take care.